This is a presentation on ratio analysis. Now, accounting ratios are relationships between figures in the financial statement which are expressed as ratios. These ratios are useful in preparing industry averages. They are useful in preparing financial statements. They are useful in comparing performance. They are also useful to measure the ability of the company to meet its short-term obligation. They are also useful in assessing the performance of companies in the same business. However, ratios can be affected by inflation. It is one of the demerits of ratios. Another demerit is it can be manipulated upon. Also, different accounting policies can affect the computation of ratios and then lastly, the difficulty in setting industry averages. There are three types of ratios of accounting ratios. We have profitability ratio, we have the liquidity ratio, and the investment ratio. The profitability ratio measures the effectiveness of the management to make profit, to make returns on their sales and investment. Under the profitability ratio, we have different ratios that are computed or calculated. We have the net profit percentage, which shows the margin of profit made from the sales, the net profit and sales. We have the gross profit percentage. We have the return on capital employed. It is the profit made as a result of the investment of the capital employed. We have the asset turnover ratio, which is the effectiveness, how effectively the company used the capital employed to generate sales. And then we have the individual sales to sales, individual expense to sales ratio. This is the individual expenses compared with sales. Secondly, we have the liquidity ratio. Liquidity ratio talks about the ability of firms to meet its obligations when it's due. Underneath this ratio, we have the working capital ratio, also known as current ratio, which is derived by dividing current liabilities by current assets. We have the asset test ratio. This is similar to the current ratio. However, the difference is the inventory is taken out from the current asset to determine the liquid asset, to determine the ability of liquid asset to meet the company's obligation. Then we have the stock turnover ratio. We have the stock to current assets ratio. We have the debtor ratio. We have the creditor ratio. We have the debtor collection period, number of days that is required to collect debt from the debtors, the creditors' payment period, the number of days it takes the firm to pay its suppliers. And lastly, we have the investment ratio. The investment ratio is used by investors to determine the return they would receive on their investments. And underneath investment ratio, we have the earnings per share, the EPS. We have the price earning ratio. We have the dividend yield, and we have the dividend cover. Purchases and sales relationship markup. Mark is a percentage that is added to the cost price to determine the selling price, while margin has a direct relationship with selling price. It is deducted from selling price to obtain the cost price. So markup is a percentage, margin is a fixed amount. Has a direct relationship. So markup is a percentage that is added to cost price to arrive at selling price. However, margin has a direct relationship with selling price and is used to obtain the cost price. And so when we have a markup of 50%, a markup of 50% can be converted to margin and it becomes 33.3%. And when a margin of 60% is converted to markup, it becomes 3 over 2. So the 3 over 5 margin, when converted to markup, becomes 3 over 2. A quick illustration is shown on the screen. We have the stock balance. In other words, an opening balance of stock 4,000. We have a closing stock balance of 10,500. We have sales 50,000. Then we have markup of 25,000, 25%, a markup of 25%. So the markup is converted to margin because the value given to us is sales and margin has a direct relationship with sales. However, it is markup has a direct relationship with cost price. But we're giving markup and we're giving sales. So we convert the markup to margin and that gives us 1 over 5. And so with the 1 over 5, we can now apply the 1 over 5 on our values to get the values that we can see on the screen. So we have opening stock, we have closing stock, and we have sales. So the 1 over 5 applied on the sales gives us the profit, gross profit. 1 over 5 on sales give us the profit because the margin is the profit. So a deduction of the gross profit from the sales give us the cost price. Give us cost price. The average stock is given there, the opening stock plus closing stock divided by 2, and the stock turnover is dividing the cost price by the average stock. So applying the formulas that have been seen above to derive the ratios, the accounting formulas have been given above there. So these formulas can be applied to daily businesses to ascertain the profitability of the firm, to ascertain the liquidity of the firm, and to ascertain the returns obtainable to investors when they invest into the business. Thank you.